Hi, I'm Adam Barrett and I'm the Head of Distribution here at Demica. The distribution function talks to all of the different groups of funders that we speak to in order to get the best pricing result for our customers on the transactions that they mandate us on. I'm here to talk to you today about current market conditions and how those are evolving in respect to a whole range of exogenous factors affecting the pricing of deals today. I think that's absolutely the case today. More than ever before on the transactions we work on here at Demica, we're getting a really wide range of outcomes from the funders who provide us with prices for the transactions that we work on. I think that's a function of the aftermath of COVID. I think it's a function of the fact that central banks have raised short-term rates and that's caused some market disruption. I think lastly it's the impact of inflation and indeed the war in Ukraine that all come together to really create quite a more volatile set of pricing outcomes than we're used to. Yes, absolutely. Historically, this is a market that's been dominated by banks who provided the majority of working capital financing to those corporate clients who have that appetite. But increasingly, we're seeing a range of non-bank investors into this market. That includes asset managers, the private equity firms through their private credit arms, insurance companies and factoring houses. What many of these investors are seeking to do is to complement rather than compete with the banking sector by providing financing to less loved sectors, you might say, or perhaps to riskier transactions that don't suit the credit appetite of the traditional bank lenders. Absolutely. I've already talked about how different types of lenders can take on different types of risks in terms of the transactions that they work on. But it's also the case, because Demica works across the whole range of working capital finance transactions, that we see innovations from lenders in terms of the way that they work on specific products. An example of this would be supply chain finance or payables transactions, where historically one of the inhibitors to rapid take-up of those programs is the KYC process associated with suppliers joining programs. Many lenders are now able to simplify that process and make it much easier for suppliers to join these programs. So the recent events at SVB or Silicon Valley Bank and Credit Suisse have certainly had an impact on funder sentiment. The funders we speak to are a little more nervous and a little more cautious. We do think, however, as the year progresses, that they'll return to operating in a similar way, and that whilst there's been a short-term blip in terms of the pricing they provide to their clients, that this will revert to trend towards the end of 2023.